Hello, welcome back. Today I'm going to talk about the conceptual framework for financial reporting. Here is my full teaching series. We are going to study the introduction and purpose, why the conceptual framework exists. So, it is the foundation of IFRS. It was first issued jointly by IASB and the FASB in 2010. It covers the objective financial reporting and the qualitative characteristics. Whereas in 2018, the IASB revised the framework to add guidance on the reporting entity. It also updated definition of assets and liabilities and clarify measurements concepts. So its purpose is to guide the IASB in developing standards, assist preparers when no IFRS applies, and ensure consistent interpretation worldwide. So that is the introduction part. We are going to look at the scope of the framework. The scope involves, it covers everything, as you can see, from objectives to qualitative characteristics, recognition, measurements, and disclosures. It also defines the building blocks of financial reportings. Okay. Then we have the users of financial reportings. The financial reports are directed primarily to investors, readers, and creditors. Also other groups like employees, suppliers, governments also use them, but the framework prioritizes those who provide resources. Then you have the other part of reporting entity and the financial statements. Here we are going to look at the a reporting entity may be a single company or part of a company or multiple entities. So consolidated statements usually combine a parent and subsidiaries, eliminating intra-group transactions. Also combined statement present related entities together but without consolidation adjustments. So that is also a continuation of the consolidated statements and the combined statements. And then we are going to check on the underlying assumptions. So the going concern, particularly assumptions underpins financial reporting. We assume the entity will continue operating. If recognition is intended, this must be disclosed and a different basis used. So that is all about the underlying assumptions which involve the going concern. Then you have the qualitative characteristics. So the useful information must be relevant and faithfully presented. So relevance here means it helps predict or confirm outcomes, whereas the faithful representation means it is complete, neutral, and free from error. Alright, let's look at the also the qualitative characteristics part 2, where we can look at the enhancing characteristics and cost constraint. The enhancing characteristics, they make information more useful. We have comparability, verifiability, timeliness, understandability, but they cannot replace relevance and faithful representation. So cost must always be weighed against the benefits. Let's go ahead and look at recognition and derecognition. So here, to recognize an item, it must meet the definition of an element, provide relevant information, and faithful representation, and faithfully represents the transaction. For example, an often purchased by a restaurant qualify as an asset. The recognition occurs when the definition is no longer met. Alright, let's look at the measurement basis. Here we are going to look at the measurements which determines the monetary amounts reported, whereas the historical cost will reflect past transaction. So while current value reflects present condition, current value includes fair value, value in use, as well as the current cost. Let's look at the presentation and disclosure. So presentation and disclosure here will communicate financial information. Standard must balance flexibility with comparability. So other comprehensive income is usually recycled profit or loss. So unless recycling reduces relevance or faithful representations. So this is all about the presentation and disclosure. So we are going also to look at the other comprehensive income, which include items like the foreign currency, translation or revaluation gains. This may be recycled to profit or loss later, but only if it improves relevance and faithful representations. So in our summary or our recap, we are going to look at the frameworks which we have said it ensures financial reporting, which provide useful information. It also define objectives, assumptions, qualitative characteristics, recognition, measurements, and disclosure. Together, this forms the backbone of IFRS. So for the exam purpose or preparation, focus on definition of elements, recognition criteria, measurement basis, OCR, recycling, and qualitative characteristics. Here is a summary chart from the objective. Then you have the continuation, also the preparation checklists. Also, to practice what you have just covered, check out my app in the descriptions. It automates this entire process for you. So the app is called Accountryx. It is the Play Store. Also, I built a dedicated app to help you master of all these topics on the go. So try it. This is the application. It's called Accountryx. So try it out and let me know your thoughts. So it covers all the modules you can learn. Also, you have some shorts, live streams that you have done. Also the quizzes as well as your progress. Okay, thank you. See you on my next video.